Welcome to SB Talks. Today is Monday, May 5th, and I am sitting down once again with our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now today, Nick and I will be discussing the Australian election result, a US earnings season, and a look back on market movements following the April 2nd Liberation Day announcement. Welcome to all our listeners. We should start with the weekend's election and a resounding victory for the ALP. I'm conscious this is not a politics podcast, but as you sit in your chair as the Chief Investment Officer, any thoughts or reflections on the outcome?
No, I don't think there's going to be a huge impact in the short term. A lot of the promises that the ALP was talking about pre-election are sort of around the edges. So in terms of the sort of impact on GDP, government spending, the budget, not a big impact there. I think the bigger thing which has been spoken about in the media in the last couple of days has been, the potential to maybe undertake some bolder reforms, particularly around productivity, things that may be, not necessarily as friendly for the electorate, potentially things like tax reform, labour market reform. We know the ALP's looked at sort of negative gearing and capital gains tax in the past, although they denied that they are, got Treasury to look at it. But I think there is, with a bigger majority, that they can take a few more risks on some of those things.
A bit more appetite for that. I'd reiterate what you said there. I think their messaging post the outcome from Sunday morning early seems to be, they talked about here, Jim Chalmers on the record talk about first term was close focus on inflation with sort of keeping an eye on productivity, and now it's sort of spun on its head. It's close focus on productivity with an eye on inflation. And let's be honest, Australia definitely needs improvements in productivity.
Yeah, no, I think we've got the worst productivity growth in decades at the moment, and with inflation coming down, I guess it's something that they can focus on. If the key to unlocking sort of real wage growth is productivity, so they need to come up with some solutions there.
I guess that'll be a watch this space, but clearly if they are sort of coming out strong in that wording, then there'll be an expectation that they provide a bit more clarity behind it in the not too distant future, hopefully.
Yeah, and with the strong majority that they have, they can definitely think longer term maybe than they have in the past.
And is it fair to say, I guess, again, from an investment perspective, the election outcome doesn't really fundamentally change anything in terms of your thinking for portfolios?
No, not really. As I said, it's not going to have a big impact on sort of tax and government spending. There's no major policy announcements that's going to impact companies from what we can see. There is some talk about maybe, changing the gas policy, which would actually be positive for some parts of the business community, but it's too early to kind of get a view on some of those things. But generally,
And I think, one point I'd say is we've talked a lot about uncertainty on this podcast, and when you have potentially a hung parliament or minority government, it doesn't necessarily create a tremendous degree of certainty because you're never quite certain how did they get the votes together to get policies through. Well, now they are clearly in a strong position, and if they set out a policy framework, they're in a position to get a lot of that potentially done. So from that perspective, I guess it creates certainty for business leaders. Staying close to home and conscious we are in a period of high flux, not so much to do with election, but more matters out of the United States and constant policy transition there. But any recent data catching your eye? Also, conscious of market expectations around the RBA and rate decreases as well?
Yeah, we've had a couple of bits of data in the last week that sort of could impact the RBA. So firstly, we had the CPI numbers. So the headline came in at 2.4%. So that's sort of bang in the middle of the RBA's target range. Now, admittedly, some of that number is influenced by things like government electricity subsidies, etc. So you have to look through that and look at the trimmed mean. And that number came in at 0.7 for the first quarter, slightly higher than expected and slightly higher than the prior quarter. The yearly number was 2.9, so a bit above expectations. So there was some commentary saying that didn't necessarily bake in a rate cut at the May meeting, which is on the 20th. But I think subsequent to that, we had first quarter retail spending. So when you look at volume of spending, so forget about price changes, that was actually flat, zero growth. And that's despite the population growing and all that sort of stuff. So really pointing to a very weak consumer.
Which is kind of consistent with a lot of other data points we've seen. Yeah. We talked here about negative per capita growth and other things. So we're seeing definite signs of significant weakness in the economy and in the consumer.
Yeah, so I think taking those two bits of data together suggests that the RBA probably will cut rates, and that's certainly fully priced for that May meeting.
Looking a little further, what's the market indicating where they go from there, the direction of travel?
Yeah, so there's 110 basis points of cuts between now and year end. So
it'll be bringing us down to 3%.
Yeah, so from 4.1 to 3% by the end of the year. So that's sort of, cuts every few months, Is that aggressive? I think, given where inflation's heading and given that softness in the economy, I think that's probably likely. But, once again, data dependent.
Yes. Step across to the US if we can. Earnings season. It's fair to say it's not so much focus on what's been reported, a lot of eyes on the guidance or potentially lack thereof.
Yeah, so 3/4 of US companies have now reported. The first quarter earnings have been very good. So coming into earnings season, people thought annual growth in earnings would be 6%. It's closer to 12%. So some pretty good numbers there. Margins have been better than expected. So that's sort of driven a lot of that. But as you say, not so much focus on the past numbers, but more what companies are saying about
the new world, the brave new world we're stepping out into
the coming quarter. So what we've really seen is, forward guidance has been cut quite a lot. It's fewer companies actually providing guidance. Those that have provided guidance have said, things are, broadly the same. But there's definitely elevated uncertainty from companies as they look forward. And the word recession was used, I think, in about a quarter of earnings calls versus 2% in the prior quarter. So a big increase in...
A dramatic spike considering the short time frame.
And that's totally understandable given, given what they're facing into.
Yeah. Business leaders there, I guess, just striking a cautionary tone, and dare I say maybe some CEOs giving themselves a little bit of flexibility as they ultimately don't know what they are going to be dealing with.
And we have seen analysts trim estimates for the coming quarter between 2 and 4%. So not huge trims so far, but definitely baking in some of that uncertainty and that growth slowdown into the numbers.
And moving a little bit higher level, what are we seeing in the US data? I'm conscious that, again, it's a bit too soon to really see too much.
Yeah, I think we've spoken about this before. So anything sort of backward looking, what we call hard data, has still been pretty good. As we said, coming into this year, we were talking about US exceptionalism, and there's an expectation that would continue. So non-farm payrolls, for example, for the month of April were better than expected, 177,000 jobs created. The market had been looking for 130. There were some downward revisions to prior numbers, but on a 3-month average, there's still pretty good strength in the labour market there. There was some cuts to federal government workers, but that was offset by gains in state and local government workers. So nothing from DOGE yet really showing up. And definitely no broad weakness in April. So I think it's still early days, but it's definitely something we're watching. We did see a little bit of a rise in initial jobless claims and continuing jobless claims last week. Potentially that was a bit of a one-off, but we'll definitely be keeping an eye on that. But at the moment, US labour market in good conditions there.
Enters this period in good condition, and we'll see how it exits.
But that's what we call hard data. Soft data, which is more surveys, forward-looking, showing a little bit of weakness. So, for example, the ISM manufacturing report for April That weakened from 49 to 48.7, which wasn't too bad, but some mixed data there, softer new orders, etc. So, that's painting to some weakness looking forward.
As you'd expect. So I guess your favourite phrase, data dependent, we just watch it closely.
And we had GDP for the US for the first quarter, which was a contraction. Actually, GDP fell 0.3% in the first quarter on an annualized basis. And I think that was the first fall for a couple of years, really driven by a surge in imports. So net exports was a negative contributor. And that's a lot of people obviously trying to
get ahead of those tariffs. So
trying to get ahead of the tariffs, So the actual consumer spending number wasn't too bad. That grew 1.8% annualized. Okay. So the consumer's still spending in the US.
Very important because it's such a large portion of the economy there.
Yeah.
We are now just over a month on from the Liberation Day and the announcement of those reciprocal tariffs. Perhaps worth using this as an opportunity to take stock of just what's happened to the markets and potentially global equities in particular over that period, but also bonds, because it's been quite a journey, but we're not necessarily all that far off from where we started.
Yeah, I mean, it's amazing to think, at one point in April, global equities were down 11%. That's the MSCI World on a currency hedge basis, and then finished the month just 0.4% down. So basically flat for the month. So quite a big turnaround from the depths of the post-Liberation Day sell-off.
So a bit of relief when we sort of saw some softening and pausing on tariffs, that the equities sort of came back and got a little bit more optimistic.
Yeah, so there was the 90-day pause, and then I think towards the back end of the month there was some media reports about potential trade deals being done, some softening in the rhetoric between the US and China. So I think there's a bit of hope that's obviously built in there. We just have to see how things progress. So over the last few days, China's exempted about 40 billion of US imports from tariffs. That's about a quarter. Right. So you remember they hit the US with 125% tariffs.
In response.
So now they've backed away on certain items, obviously things that are important.
Strategically important things to their economy that they don't want to be hiking.
And they've also indicated that they're open to discussing with the US how they can, what the US is seeking in terms of fentanyl precursor chemicals. So these are chemicals that get shipped to the US or to Mexico, that then can be used to make fentanyl. So you might recall the original 20% tariffs on China were related to fentanyl. So the Chinese appeared to be, open to exploring what can be done there. So I think it's sort of heading in the right direction.
Constructive,
yeah.
Yeah. Conservatively will be modestly constructive at this point.
But it's interesting to note some real-time data on shipments between China and the US in the second half of April are down 30 to 40%.
Yes, I read some of those reports in the weekend. That's quite dramatic. If you're operating business in that space, it's just cannot adjust for that.
Well, that's right, and companies like Walmart and Home Depot are talking about potentially empty shelves.
And the scramble for bonded warehouses in places like California as well, where you can take your imports, put them into a bonded warehouse, and technically while it stays in there, it's not been imported yet, so you can manage the timing in the hope or expectation that you're going to get a better tariff deal when you remove it. But a system that's just not going to be built for this, so it's sort of going to severely stress that part of the infrastructure around import-export.
Yeah.
Very interesting as always, Nick. I guess where we sit today, we continue to manage things cautiously. We, take the positives, but we remain sort of prudently cautious about the outlook. And we expect that this is going to be a slow, drawn-out process.
I think we're in for a period of, elevated uncertainty. Definitely, I think growth will be slower than what we thought coming into this year, even if a lot of these tariffs get negotiated away. Just all that uncertainty means that businesses and consumers will probably be doing less.
And we'll inevitably end with some level of baseline tariffs, and some strategic tariffs will definitely
undoubtedly
prevail. Excellent run through as always, Nick. Greatly appreciate it. Thank you. And thank you to all our listeners.
Thanks.